Well, welcome Investorholics and casual viewers to another ETF Spotlight review. Today we'll be taking a look at MNRS, which is the BetaShares Global Miners ETF, currency hedged. And as we just mentioned, this is brought to you by the fantastic folks at BetaShares. So if you're interested in investing in gold but want exposure to the upside of the actual miners, then this ETF could be for you. MNRS could give you simple and cost-effective exposure to a diversified portfolio of the world's leading gold mining companies, and also there's a couple of royalty companies in there, gold royalty companies, and this one's all listed on the ASX, nice and easy to invest in one simple trade. You get exposure to all the companies in the index. So you'd be able to get a bit of capital appreciation, so it aims to provide a long-term capital growth potential as the primary driver for return. So we're not just looking at the gold price, but capital appreciation of these companies, and obviously the gold price is mixed in a bit there. Gives you a bit of portfolio diversification, so the fund can be used to introduce regional, sector or asset class diversification in your portfolio. So stick around if you're interested in gold and also gold miners, so a different way to get exposure to the gold price, upside of the gold price. Well, hello there Investorholics, this is Scott. KrackTheSky Value Investing will be giving you up-to-date investing news and content so you can navigate the markets wherever you are. My mission is to give you the knowledge and confidence to take control of your own personal finances, expand your investment horizons, and crack your financial sky. Okay, so fund objective. MNRS tracks performance of the index before all the expenses and all the fees, and provides exposure to the largest global gold mining companies, excluding companies listed in Australia, hedged into Australian dollars. That is not entirely true because there are a couple of companies that are cross-listed, so they'll be listed on the Canadian exchange and on the Australian exchange, like Kirkland. So that is not entirely accurate, but in the broad sense that's true. So index is the Nasdaq Global X Australia Gold Miners Index, and it's designed to track the performance of the largest and most liquid companies engaged in silver, gold, and other precious metals mining. And that one obviously excludes Australia to the best of the ability of the index, because there are some cross listings included in the index. Why do we want to bother buying such an interesting ETF? So diversification. So MNRS offers diversification and defensive benefits, as gold miners' fortunes are closely tied to the price of the gold, which traditionally tends to perform well during times of market volatility and uncertainty. So similar idea here to owning physical gold, so it's a hedge against uncertainty and a store of wealth, effectively another type of money, to be honest. Spread gold sector risk. So investing in global gold miners enables you to simply and cost effectively spread your risk beyond a relatively small Australian gold mining industry. Cost effective. So it's passive. Index tracking approach means no active manager. The fees are lower, making MNRS a cost-effective investment for people seeking exposure to the global gold mining sector. I like the gold miners as opposed to the gold itself, but I'm kind of interested in where the gold comes from and how it's dug out of the ground and all those type of things, so possibly a little bit different to some people. Okay, so we had a net asset value of $7.18. It was trading just above that at $7.20. Management cost is pretty reasonable. You're looking at 0.47%. You do have some additional expenses, which is 0.1%. So total fees, you're looking at 0.57%, and you get a distribution semi-annually, so June, July, and that's why I like this over physical gold ETFs. You actually get a distribution, so you get some money back in your pocket in the form of a dividend. When I checked the dividend yield, it was 2.2%. So the fund can be used to give you critical exposure to the global gold mining sector, as we kind of mentioned. Can provide a core component of a global equities allocation, providing transparency and diversification benefits. Buying MNRS is another way to invest in the gold story rather than directly into physical gold ETFs or actual gold mining companies. You get the hedge against the risk that most people are looking for, and also you got the potential upside from being involved in the actual companies. So just a bit of news. Recently, hedge fund Bridgewater Associates raised its investments in gold-backed exchange-traded funds by a third in the second quarter of this year. So buying the equivalent of 170,000 ounces of gold worth $340 million US, and that was at the current prices. That was a few weeks back now, so that's not current, but you know, it's quite a big whack all at once. And that was in their recent filings. When they do those big transactions, they all have to be filed in the US so that everyone knows what's going on. So the move is part of a wider rush amongst investors to buy gold, which they hope will hold its value as the coronavirus crisis upends markets and pushes down returns on bonds. So once again, looking for a store of value. The total value of Bridgewater Associates assets included in the most recent 13F filing, which disclosed equity investments, was $6 billion. So they've been building this position for quite a long time. It's always good to have a look at alternatives when we're doing our research. So have a look at GDX. So GDX and MNRS are pretty much, I think from memory, the only two ETFs that focus on gold mining companies. But you know, there's also a lot of company, sort of other ETFs which I've touched on in previous videos that just purchase a physical gold or a link to the physical gold assets as an investment. So look at PM Gold as well. That's another option for investing. So as I say, you know, there's definitely been a move into gold as a store of value as volatility rises, which is quite typical, and it happens quite regularly in this part of the cycle. So we saw that in 2008, 2009, people tried to get out of the actual, you know, share market or equities, and then put their money into gold and other fixed assets. So they, you know, try to preserve the value of their money. As we know, putting in the bank nowadays doesn't generate any returns. Okay, let's have a quick look at the top 10 holdings. So Franco-Nevada and Wheaton Precious Metals Corp, they're both gold royalty companies. I think they're probably the two biggest, that's my guess. You had up next you got Barrick, then you got Newmont, then you got AGNICO-EAGLE Mines, never heard of those. Kinross, Goldfields, Kirkland Lake, I think it's listed in Australia as well. Anglo Gold Ashanti, and you got Polymetal International, never heard of those guys. We've had, since inception, a pretty good, you would have had a pretty good run, looking at 8.76% per annum, which isn't too bad. The best run you had with this one is in the last 6 months. So if you bought into in the last 6 months, you would have done a 62%, almost 63%. So Ray Dalio predicts that the primary benefits of the dollar's downfall will be to gold and stocks. There's not been yet a good alternative in the form of currency, because the three main reserve currencies all have the same basic problems. That's why investors move into new storehold of wealth, so they're looking for gold and that type of stuff to try to preserve their wealth. And in that storehold of wealth is equities, gold, and other asset classes that go up. So they're pretty much you're trying to effectively time the cycle, which is a bit dodgy. But I think this gold in general, I think there's still a bit more of that story to play out, because there'll be a bit more volatility in the market for the next 12 to 18 months, maybe 24 months. So if you're interested in gold as an investment, it may pay to have a look at this one. But as always, we try to put it into a sort of a balanced portfolio if we can. So I wouldn't be looking at any more than 10% of your overall portfolio allocated to gold. I mean, if you're interested, maybe you put 5% in one of the gold mining ETFs, so MNRS or GDX, and then you put another 5% into one of the ETFs that hold physical gold, PM Gold, or one of the other ones. Check out the comparison I did. I'll leave the card up in the corner there so you can have a look at it. But yeah, keep your eyes out. Definitely interesting investment. How long you hold a lot of gold in your portfolio is really a decision for you guys, but it's something worth considering. As I say, as a store of gold, and try to take a little bit of the volatility out of the market, as just in simple equities. But yeah, it pays a little bit of a dividend, so it's definitely worth looking at. I like these type of the miners as opposed to the physical gold anyway, because they do pay a dividend. So that's a bit more money back in your pocket to reinvest somewhere else or buy more shares in the ETF. Thanks. Are you interested in learning more about personal finance and investing in the markets? If you are, then smash the like here on the left hand side and caress the subscribe button on the right hand side. It's KrackTheSky Value Investing. We'll be giving you up-to-date investing news and content so you can navigate the markets wherever you are. Expand your investment horizon and crack your financial sky. Thanks guys. See you later.